Tyler, our catchy headline for this video is, should investors buy Enphase before February 4th? What happens on February 4th?
That sounds right about earnings time, isn't it?
You got it, buddy. Enphase reports earnings on February 4th. After the market closes, their earnings call is at 4:30. Investors will have a couple of market days from the time this video drops to buy shares. Let's talk about what's happened with Enphase over the past couple of years, why investors might want to even be thinking about buying before it reports earnings. You ready to dig in?
It's been a wild swing in the cycle, and I think you're looking to make the case that might be swinging back the other way.
Yeah, maybe so. There's some signs. There are some signs that that's the case. I'm Jason Hall. This is Investing Unscripted. Tyler and I are going to dig in to what I think is a great stock. Tyler's going to be the voice of patience here and caution, but we're going to get into it. Before we get into the details, though, this video is sponsored by The Motley Fool. If you're looking for even more great stock ideas, you should go check out our special link. Go to fool.com/unscripted, and you can get access to The Motley Fool's 10 best stocks to buy now. Go check that out. Again, it's fool.com/unscripted. All right, Enphase. Short version, Tyler. This is the company that manufactures the electronics that go on solar panels to manage the power that comes out of them, connect them to the grid, connect them to your ecosystem with the app to manage it. They do a lot of batteries. Residential solar is where they focus. Was one of the big winners of the cycle coming up over the decade prior. But the past couple of years has been, what was the word that you used to describe it?
Volatile? I think I might have even mentioned violent.
I think brutal is probably the best word.
Brutal,
because it is
violent. There's a
brutal
lot.
for shareholders of the company since the peak.
We've mentioned it a couple other times before. This has been a big interest rate story. One of the major solar industry, especially residential, was a major beneficiary of low interest rates, cheap capital to fund the installation of facilities. With higher interest costs, people have been a little less incented to do so. It's a little hard to make the numbers work when your interest payments are closer to 7 to 9% versus, I don't know, 3 to 4. So with that in mind, we've seen a major scale back. On top of that, we've seen some changes in the solar installation industry, especially on the residential side. The post cheap capital time of 2020, 2021 into recently has been a pretty epic decline, not just for the stock prices, but for just business in general. I don't want to call it the absolute peak in 2022 in terms of revenue, but right around there, since then, revenue has declined more than half from those highs.
Yeah, from the peak, from quarter to quarter, we're talking like 60 to 70% reductions on quarterly basis. Over full years, it's a little bit softer, but it's been brutal. What I was sharing on the screen, just to explain it for people, the purple, this is a common valuation metric that gets used, but I'm using in this case to show how extremely valued the stock had become. This is price to sales, was regularly trading in the teens for multiple years during that run up, right? And we saw the stock price, again, the yellow line, continue to run higher and higher because business is growing. And it was one of those things where I think a lot of investors, even though you and I a common refrain for both it and SolarEdge, which is its biggest competitor that does a lot of the same thing, their stocks seem to defy gravity. And it was hard to figure out how companies in the space that they were in were able to continually get the margins that they were getting, generate the cash flows that they were able to generate, and the market continued to value them very, very richly. We've seen that's come down a lot, right? But I want to make the case for why investors might want to consider buying Enphase.
Try to convince me. I'll be the skeptical person that you need to convince.
All right. I appreciate that. So we need always to have that hand of calm and patience when we're thinking about cyclical industries. First of all, policy changes have created some headwinds for residential solar as well. Interest rates remain high and are likely to remain above levels we saw for most of the past 12 to 14 years. They're likely to stay well above that, even if we do see more reductions in interest rates in the coming years ahead. What's having to happen is the industry's having to adjust, right? We continue to see some innovations that are driving costs out. Panels continue to get more efficient, driving down cost per watt. That's going to help adjust some of the cost. Tyler, we're also seeing a lot of pressures on utilities, and utility prices are going up. So even if solar is able to simply hold the line on the actual costs before financing, utility costs continue to go up. That makes solar look more attractive. That could start to create renewed interest in solar, residential solar, simply because those utility bills continue to be so onerous for more and more people. You mentioned batteries in California. Batteries have become a bigger attachment across the entire solar world. Grids do need to manage the power, and you can't just expect to push the power from your solar panels to the grid when it doesn't need it, and then pay the same cost to get power when you can't get it from your panels. The grid has to be balanced. Batteries are helping unlock that potential, and Enphase is one of the leaders in residential batteries. Their ecosystem is one of the most powerful in terms of being able to leverage your panels and your batteries, take advantage of incentives that utilities might offer. We just saw an announcement from the company with one of the largest utilities in the United Kingdom that allows Enphase customers to leverage their batteries and their panels and the microinverters that control those panels to maximize the tariffs there. So, and again, it's managing the ins and outs of when the power is needed versus when it's not. And this is a real leader in that space. Through this whole downturn, Tyler, we've seen their battery unit sales continue to grow every single quarter. That part of their business has continued to grow. That is a very positive sign. Now, again, it's been brutal on the microinverter side because panel sales are down. On unit basis, we're talking 70% plus, 75% plus declines. But I want to share what I think in the long term for a business is maybe the most important number that investors need to understand. And that's this orange, and that's free cash flow. From the peak levels of revenue, companies' free cash flow increased and increased. We saw it flatline a little bit because they were making some investments to grow their capacity. And then interest rates skyrocketed and snatched the rug from under everybody in the industry. Revenues declined sharply, flatlined. Again, we've seen the business start to show some signs that revenue could be growing again. I want to point out, though, March report, that's the winter.
I'm guessing there's not a lot of installations happening up where you are in New England.
So they're not happening here, but they're happening across this, right? So they're going up during the summertime, right? The point, though, is there are some signs that this looks like a little bit of a return to growth. What's happening is the company's taking market share from SolarEdge and from other competitors. But the orange, I want to get back to that. Even during these lowest periods of revenue, the company's continued to generate free cash flow. That's massively valuable. That tells you that this is a company that has structured itself in its cyclical industry, even when volumes can fall 70%, that it can still live off of its own operations and its own balance sheet. That is remarkably powerful. Here's the last thing. Here's the thing that I want to say makes this an appealing stock to buy today, to buy now, even so close to earnings before the company reports earnings. It's price to free cash flow looks expensive right now based on the cash flow that it's generated over the past 4 quarters. If you look at that peak, it generated a little over $800 million of free cash flow. It's most in a 4-quarter period. Let's back that down and just say, let's say we can get back to $600 million in free cash flow. It's about $340 million over its past 4 quarters. We get back to $600 million a year in free cash flow. The stock price today is about 13 times that level of free cash flow. Let's call that like a mid-cycle level of free cash flow. To me, that's incredibly cheap. If you think about the secular tailwinds behind renewables, how well this company is run, and the long-term potential.
That's a thesis that makes sense. And I will give company credit for being a manufacturer that was somehow able to still eke out cash flow, even though its sales dropped by like 60, 70%. That's not often you see that in most manufacturing businesses. The two holes or the two challenges I see to the thesis is with higher interest rates not going away anytime soon, how much is that going to impede its growth trajectory over the next several years? It will grow, but I don't think it's going to grow at the rates that we were accustomed to. The other one being is, yes, it can get back to its, we'll call it mid-cycle free cash flow. How long will that take at a slower growth pace? And those, I think, are the two things that you have to look at where it's like, yes, it could be trading for 13 times normalized free cash flow, but what if that doesn't happen till 2027, 2028? And then all of a sudden it's a relatively slow growth business that for what is it, like 45 times free cash flow today to get to 13 times 3 to 4 years from now? That's, okay, but it's not like got me running for the buy button.
I think you're exactly right. And I was expecting that those would be the things that you brought up, because if you didn't, I was going to. I like the price right now because I like the business. I don't think it's a time to just load up the truck, though. Because of so much uncertainty, this is an opportunity for investors to gain some exposure, maybe add a little bit to an existing position. This is the kind of stock that you want to build out your position over months and quarters and years even. And there's so much risk of opportunity costs of tying up a full position right now in the midst of so much uncertainty, that tying up that capital right now and the opportunity costs of underperformance, I think is still measurable. Tyler, you're spot on. Think about building it up over the long term. We're sure going to learn a lot more on February 4th when we get earnings.